Hello and welcome to this review on direct participation programs. Direct participation programs can be organized to invest in real estate, oil and gas, mining operations, and equipment leasing interests. We're going to take a look at the various structures of direct participation programs, and we're going to evaluate the risk and reward potential for various direct participation programs. Many direct participation programs are organized as limited partnerships. A limited partnership has a general partner who brings the business acumen and business expertise to the partnership. They manage the day-to-day business of that partnership. They can conduct business on behalf of the partners. The limited partners provide the capital for the limited partnership. So the general partner manages the business. The limited partners provide the capital to operate the business. Now, it's important to note that a limited partner may never influence the general partner, nor may they make decisions on behalf of the partnership. If they did influence or control the general partner, or if they made decisions on behalf of the partnership, they would risk losing their status as a limited partner, and therefore they would be classified as a general partner. Now, sometimes the exam will give you a scenario where you have one general partner and 27 limited partners and ask you who can conduct business or enter an order for the benefit of the partnership. It is exclusively that general partner. When a limited partnership is formed, the partnership will file a certificate of limited partnership with the state where the partnership is organized. It will also advertise the partnership, announcing its formation for a period of time to be determined by each state. So a limited partnership is definitely one form that is very popular to structure a direct participation program. A direct participation program could also be formed as a subchapter S corporation. A subchapter S corporation allows for the flow-through of the economic events to the shareholders. There's a maximum of 100 shareholders allowed in an S corporation, and it must be a domestic corporation. It cannot be a foreign corporation. Shareholders are limited to individuals, estates, and trusts. A corporation may not own an interest in a subchapter S corporation. Now, limited partnerships and S corporations allow for the flow-through of all economic events to the interested partners or shareholders. So all income, expenses, and losses are passed through. There are no economic events that take place at the direct participation level. So all economic events, all income, expenses, losses, deductions, tax credits, they all go to the limited partners or the shareholders. Now, this is very, very special tax treatment for these entities. It is unlike a traditional corporation where a corporation pays taxes at its own rate. A C corporation pays its taxes at its corporate rate, and if it wants to pay out a dividend to shareholders, will pay a dividend to shareholders from after-tax income, and the investors who receive those dividends will then be taxed on that again, so it's subject to double taxation. Now, in order to qualify for this special tax treatment, the direct participation program must avoid at least two of the characteristics of a corporation. The easiest one to avoid is continuity of life. When you organize a C corporation or incorporate as a C corporation, that corporation is in existence for perpetuity. It is there forever or until it goes bankrupt or someone acquires it. So these direct participation programs will traditionally set an end date for the organization. The partnership will cease operations as of June 1st, 2055, or upon the distribution of all assets. Continuity of life is now avoided. You cannot avoid a profit motive. The direct participation program must be organized to earn a profit. And central management, well, the partners are going to require that there is central management. There is a business expert there managing the affairs on their behalf. Limited liability, the limited partners or the shareholders are going to demand limited liability. So it's going to be very difficult to avoid that. The other characteristic that is easy to avoid is freely transferable shares. If you own stock in Apple, IBM, Intel, what have you, and you want to sell that stock, you can sell it at any day you like to whomever you wish. It is freely transferable. Partnership interests are not freely transferable. You may not sell them to whomever you wish. You may not sell it to a substitute limited partner. The only time that you would be allowed to sell your interest to another party would be if the general partner or managing member or partner accepted the substitute. So it would only be transferred upon acceptance. Therefore, it is not freely transferable. So I would make sure that I know these two concepts. Continuity of life and freely transferable interests are the two characteristics of a corporation that the partnership will be able to avoid and therefore will enjoy the special tax treatment. Now, the general partner, we said, acts on behalf of the partnership. They're able to buy and sell property on behalf of the partners. And for this service, they're going to receive a management fee. And that management fee will be spelled out in the partnership agreement. It will tell them how much the general partner's compensation is. The general partner is required to maintain a minimum interest in the partnership of at least 1%. So they must have some economic skin in the game, as they say. Now, the general partner is precluded or prohibited from competing with the partnership or commingling their assets with those assets of the partnership. So let's say the general partner is in the oil and gas business and is managing an oil and gas direct participation program for the limited partners. Well, the general partner would not be allowed to set up its own drill rig right down the road from the partners. That would be competing with the partnership. Now, the limited partnership agreement, it is the foundation of the partnership. It spells out a number of things. Clearly, it states the name of the partnership and a description of the business. It tells you about the life of the partnership. How long is this going to last? When will we cease operations? Any conditions for assignments to limited partners? Any conditions for admitting new or substitute limited partners? This is all laid out in the partnership agreement. If there is a material change to any of the information in the partnership agreement, it must be updated within 30 days. So the partnership agreement spells out the organizational objectives of the partnership. The subscription agreement is where the limited partners actually subscribe to or is the purchase document for their interest in the partnership. Here in this subscription agreement, there is going to be language relating to the power of the general partner. And the general partner will be granted a power of attorney to transact business on behalf of that partnership. It will also disclose suitability information relating to the prospective purchaser. 1, what is your income? 2, what is your net worth? 3, you acknowledge the risk associated with this investment and you know that you can afford the risk associated with the investment. This is the document that the general partner is going to review and use this to determine whether the limited partner should be accepted as such. Most direct participation programs are sold through private placements. Some are sold through a public offering, but not many. There is going to be a maximum syndicator fee or commission to the firm that distributes these interests of 10%, with a maximum total discount for all distribution expenses of 15%. A master limited partnership is one that has a secondary market develop, meaning you could buy or sell these interests on NASDAQ or on an exchange. Now let's take a look at several different real estate limited partnerships someone could invest in. And we're going to start off our review with an existing property. When an investor purchases an interest in a limited partnership that acquires existing property, they are buying a property with predictable cash flow. It has a rental history. So this is the main benefit of the existing property. You have a reasonable expectation of what the rental income will be over time. The disadvantages to this type of partnership are that there are ongoing expenses in repairs and maintenance. The biggest tax advantage or benefit to this type of program is depreciation of the building. Maybe it's a large apartment building. Maybe it's a large office complex. You will get to depreciate that, and interest on any existing mortgage. You will get to write that off. Now, a new construction partnership, it is formed to build new apartments, new condos, new office parks, what have you. The risk is higher than with existing property because you don't know if you're going to be able to rent it, if that is the partnership's intention, or you don't know if you're going to be able to sell it, if that is the partnership's intention. However, if they do sell this property, the potential for capital gains is significant. The tax benefits here are expenses required to build the property. They're going to generate a lot of write-offs there. And once the building is complete, it will be able to be depreciated. The most speculative type of real estate limited partnership is raw land. The only thing that can happen with raw land is you buy it for a price, and somewhere down the line, someone wants to buy it from you at a higher price. You cannot depreciate land. Land is land is land. It does not lose value over time. Therefore, there are going to be no tax benefits, no write-offs. The only reason you would do this is for capital gains. Perhaps someone is going to come along and pay you a higher price somewhere down the line. This is the highest risk real estate limited partnership. Raw land, no tax benefits, only that potential for appreciation. A real estate limited partnership could also be formed to invest in low-income housing. There's generally low risk here because the government tends to subsidize these type of projects, and you get a significant amount of tax credits. The problem here is there's going to be high maintenance and repair costs, and the government could change the laws and regulations or program rules that could negatively impact the performance or the return of the partnership. The tax benefits that flow through are those tax credits, and any losses will also flow through to investors in the limited partnership. Historic rehabilitation. Here you are buying, the George Washington slept here type of property that is of historic significance. Significant risk here because it's hard to get financing for these properties, and it's hard to rent them out. You don't ultimately know what the use of these properties will be. You will get some tax credits in the form of credits from the government for maintaining and repairing these historic landmark sites. However, there is a significant amount of risk involved as it relates to financing and rental income potential. So this would tend to be one of the highest risk real estate limited partnerships. It'd almost be up there with that raw land. Now, limited partnerships will also be formed to invest in oil and gas programs. When you buy an income program, you are buying existing wells. With existing wells, you know what the production is, you know what it should be in the future, and you have a good understanding of the proven reserves in these particular wells. There is predictable cash flow. However, you cannot predict the price of the commodity, the oil or gas. If oil falls in value or gas falls in value, you may not be able to operate the partnership profitably. Now, when you have natural resources, you do not depreciate them. You depreciate fixed assets. You deplete natural resources. So oil, gas, gold, silver, they are all depleted because at some point those natural resources will have been removed from the ground. So the tax write-offs that you receive from oil and gas partnerships is not depreciation, it is a depletion allowance. When you have a developmental well program, it's also known as a step-out well program. Effectively, what you're doing is you're going into an area where there are known reserves, where these wells are currently producing, and you are drilling in about the same area, hoping that the oil field or gas field extends onto the property where you are drilling. This is a little bit higher risk. There is no guarantee that you will find oil, but there is a higher probability that you will because there are known reserves in the area. The developmental program produces write-offs in the form of intangible drilling costs. Intangible drilling costs are those costs absorbed that have no salvage value. Things like wages, fuel, insurance, surveys, all of these, once they have been used, are gone. Once you spent the money on wages, you can't get them back from people. Once you've spent the money on insurance, you don't get it back. Once you've used the fuel, it's gone. Once you've spent the money on a geological survey, that money is gone as well. There's no salvage value. Those are intangible drilling costs. A wildcat well or exploratory well, you are out there drilling for oil in an area where no one has drilled before. It is the riskiest type of oil and gas drilling program. A high probability that the investors will lose everything because most fields never produce. But if it does begin to produce, it's an absolute home run. Tax benefits are the intangible drilling costs. And here we're going to recap the IDCs once again. Intangible drilling costs are 100% deductible in the year in which they are incurred. And those are, again, geological surveys, wages, supplies, insurance, and fuel. Things that have salvage value are not included in intangible drilling costs. Things like wellheads, they can be salvaged. Storage tanks, they have salvage value. Even the well casings may have salvage value. So these are all good things to have a firm grasp on come test time. All right, now that we've reviewed a variety of different types of oil and gas programs, we need to take a look at several ways the revenue can be shared between the general partner and the limited partner. With functional allocation, limited partners receive the intangible drilling costs, and the general partner takes the property write-offs or the depreciation. The revenue is shared between the limited partners and the general partner. With a reversionary working interest, The limited partners absorb all of the costs and expenses, and the general partner receives no payment of any kind until the limited partners have received their investment back. That is a reversionary working interest. With a disproportionate working interest, the general partner receives a large portion of revenue, but only bears a small portion of the cost. That is a disproportionate working interest. An overriding royalty interest is given to a holder of an asset who does not participate in the partnership and only receives a royalty on the production. Perhaps a landowner has been approached by an oil and gas company, and they wish to drill for oil and gas on that landowner's property. They feel that the property contains reserves and they want to go after them. The landowner says, well, I have no interest in drilling for oil or gas on my property, but I will let you drill on the back 40, and in exchange, I want a 5% royalty on whatever it is you pull from the ground on my property. That would be an overriding royalty interest. The tax reporting for a direct participation program is pretty straightforward. The program itself has no economic events, and all of the economic events pass through to the investors. Now, when the partnership generates losses, those losses will be passed through to the limited partners. However, they may only be used to offset other passive income. They may not use those losses to offset their earned income or W-2 income. Now, there is a term you want to be familiar with for your test known as the crossover point. The crossover point is the point where the partnership has used up all of their write-offs and now starts generating taxable income to the investors. So once all of the write-offs have been taken, if the partnership is generating revenue, it creates a taxable event to that holder. So that is known as the crossover point. I'll also bring up another term here known as recapture. If a direct participation program has been depreciating a building, let's say, and the building cost $20 million, and they've depreciated it over the years, so that's now being carried on the books of the partnership for $10 million. That is their carried value. And they subsequently sell that property for, say, $15 million. Well, that $5 million becomes a taxable event because the asset was sold at a price higher than its depreciated cost basis. Tax reporting and tax regulations here. Investors should buy direct participation programs because they want to make money. It should not be purchased as merely a means for sheltering income. If the IRS determines that the partnership was only formed to generate tax benefits to its investors, well, the investors could owe back taxes, or they could even be sued for fraud. Now, another type of DPP could be organized to lease large industrial equipment, planes, trains, construction equipment. These large pieces of equipment will be leased by corporations. The investors will enjoy the income generated by those lease payments, and they will have the opportunity to depreciate that asset over its useful life. So a DPP could be organized to lease planes, trains, cranes, ships, large construction equipment, and the lease payments made by the corporation will then be passed through to the interested partners. The depreciation will reduce the taxable income, and they'll also get to deduct any expenses incurred in the operation of the partnership. Now, I want to do a comparison here of tax credits versus tax deductions. A tax deduction reduces the amount of income upon which you are taxed. So if you have a $10,000 tax deduction and the person, for the sake of a round number, made $100,000, they would tell the IRS that they made $90,000 that year, and their tax liability would be based on that $90,000. A tax credit reduces your tax liability dollar for dollar. So if you have a $10,000 tax credit and you owed the government $12,000 in taxes, you would only owe the government $2,000 after taking that tax credit. A tax credit reduces your tax liability dollar for dollar. When analyzing a limited partnership, the most important thing is economic viability. Will it work? Will it make money? What type of tax considerations or benefits will I get for investing in this partnership? How good is the management? Do they have a proven track record of doing well in this field? You have to understand these partnership interests are very illiquid, and you need to understand that there is a tremendous lack of liquidity, and an investor who is considering placing money into a DPP should be able to lock up that money for a long period of time, meaning they have a very long time horizon. So these are some of the features that the investor would want to review prior to investing in a limited partnership. Some of the other things that they would want to review is what type of partnership is this? Is it a program where they have identified the assets they are going to purchase, or is it a blind pool where 75% or more of the assets have not yet been identified? For example, we are going to operate residential commercial apartment buildings. We just haven't identified which ones we're buying yet. A limited partnership's internal rate of return is used to measure the performance of one limited partnership against another. The internal rate of return is the investor's overall return for participating in that partnership. And the higher the IRR, the better the partnership's performance is. Now, when a partnership dissolves, who gets paid when? Well, secured lenders get whatever they were promised. They get collateral, title to the collateral if the partnership has defaulted. Then general creditors. Then limited partners will receive any profits, then the return of their investment. Then the general partner will receive their fees, and then they will receive their profits or return of capital. So this is the order that a limited partnership would liquidate in. Now, there are two types of loans that can be taken out by a partnership. The first is a non-recourse loan. And with a non-recourse loan, the lender cannot pursue recovery from the limited partners, meaning they have no recourse. Because they have no recourse, the limited partners have no responsibility for the repayment of the debt, and their liability is only limited to the amount of money they had placed in the partnership. Now, with a recourse loan, the lender has recourse to the limited partners. And with the recourse loan, that recourse can increase the investor's cost base for the partnership program. Now, here we have a little example of a partnership that has $10 million in assets, and one person put up $1 million of that 10 million. They have a 10% interest in that partnership. They have taken out a recourse mortgage loan for $2 million. If this partnership goes bad on this mortgage or defaults on the mortgage, that particular person is going to be responsible for the repayment of 10% of that loan, or $200,000. Each partner would be responsible for their percentage contribution to the partnership. So big difference between a non-recourse loan and a recourse loan. The recourse loan can require the limited partner to invest additional capital to cover the shortfall on any particular loan. So some great work there on direct participation programs and limited partnerships, the different types of structures, the different types of investments, and the different types of risks and rewards available with each type of partnership. It's a great time to go back and review this material in your text and to take a few questions in our test bank. And we will see you in the next section.